The Joint Legislative Audit and Review Commission will come to order, and if we could have the roll taken, please.
Nathan, would you like to take the roll, please?
Good morning, everyone. Do we have Delegate Austin this morning?
Here.
Thank you. Delegate Byron was going to join us remotely, but has not. Delegate Carr? Present. Thank you. Delegate Knight?
Here.
Delegate Orrock? Has a nameplate, but is not here. Delegate Plum? Is not here. Delegate Torian? No. Delegate Ware?
Here.
Thank you. Delegate Wilt?
Here.
Thank you. Senator Howell?
Here.
Senator Locke?
Here.
Senator McPike?
Here.
Thank you. Senator Normand?
Here.
Thank you. Senator Spruill?
Here.
And Ms. Henshaw. Thank you all.
Good morning,
Hal.
Madam Chair and members of the Commission. I'm Hal Greer, the Staff Director of JLARC. As those of you who've served on the Commission for some time know, the July meeting is the meeting each year at which the Commission focuses on the Virginia retirement system and Virginia 529 and its programs. The Code of Virginia expressly directs JLARC to conduct ongoing oversight of both. This morning, JLARC staff will present brief oversight reports on both VRS and Virginia 529, but the bulk of the time will be reserved for presentations from the leadership of VRS and Virginia 529 and any questions that you have of them. With that, I'd like to turn it over to Kimberly Sartay, who oversees our ongoing oversight. Kimberly?
Good morning.
Good morning, Madam Chair, and thank you, Hal. Yes, so I will be kind of guiding you through today's meeting. As Hal mentioned, today's meeting is dedicated to JLARC's oversight of VRS and Virginia 529. So to start, I thought it would be helpful for the new members to briefly explain why JLARC has ongoing oversight of these two agencies. JLARC's oversight of VRS stems from several important reports released in the early 1990s, which recommended changes to VRS's governance structure and investment practices. And these reports led to the governance structure that is largely in place today. And they also led to the VRS Oversight Act, which was passed by the General Assembly in 1994 and gave JLARC ongoing oversight of VRS. JLARC's oversight of Virginia 529 stems from a recommendation coming out of the 2011 Governor's Commission on Government Reform and Restructuring, and the College Savings Plan Oversight Act was passed by the General Assembly in 2012, and again, it gave JLARC ongoing oversight of Virginia 529. These two acts require JLARC to provide regular reports and briefings on VRS and Virginia 529 to the Commission. So to start today's meeting, Jamie Bitts, who is JLARC's oversight analyst, will be providing you with our oversight briefing on VRS. We provide two updates to you on VRS each year. One is the July briefing, which we will be providing to you today, and then we will be back to provide you another update in December. Jamie?
Well, good morning, Madam Chair, and thank you, Kimberly. As Kimberly said, my name is Jamie Bitts, and I'll be presenting JLARC's July semi-annual oversight report. And I'll pause a moment to let the slides, there we go. This slide is just a reminder that our report is required by the VRS Oversight Act, and that does require several other oversight activities as well. My presentation this morning will cover VRS trust fund investments, their defined contribution plans, and then relevant legislation from this past session. Now, a core responsibility of VRS is managing the investment of assets in the VRS Trust Fund. This is important because the assets used to pay VRS benefits are pooled in the trust fund. Those benefits include retirement benefits for state employees, teachers, and local government employees, as well as other benefits such as life insurance, sickness and disability benefits as well. Now, the most recent return data available for this report is through March 31st. As of that date, the trust fund had achieved a 12.3% return. for the 1-year period, and that does amount to a roughly $10 billion increase in the trust fund, bringing it to a total of about $106 billion. Now, of course, returns for the full fiscal year 22 are expected to be lower, but that said, total fund returns through March 31st were all above the long-term return assumption of 6.75% for all periods. Now, the next couple of slides just show you the performance of the trust fund and its asset classes. And I should say by way of background that in advance of that performance compared to the investment benchmarks, that matters because investment returns are a key source of income for the trust fund. The other primary source of income is the employer contribution rates that are paid by state agencies and local government employers. Those rates are based on the returns meeting the long-term return assumption that's assumed by the VRS board. If returns are below that assumption, funds would need to be made up elsewhere and rates may need to be in the long term higher. Of course, rates could potentially be lower if that return assumption is exceeded. This slide just gives you some additional detail on the trust fund's overall performance. And so you can see that returns for all periods exceeded the benchmarks as well as that 6.75% return assumption. The trust fund is a diversified portfolio. Its investments are allocated across 7 different asset classes, and they're ordered here from largest to smallest. All but one of those asset classes exceeded their benchmarks for all or almost all of their periods. Public equity did miss each of its benchmarks, but I should say that public equity did have positive returns for all of those periods, just not up to the benchmarks. And VRS staff attributed that underperformance of the public equity assets to the market, essentially favoring growth stocks over the value strategy that VRS is pursuing. I should say that the VRS board did recently appoint a new CIO to manage the trust fund. The current CIO is retiring after more than 10 years in the position. The board has appointed Andrew Junkin after a national search, and he'll come to VRS from Rhode Island, where he's served as CIO for their retirement programs as well. And now I'll turn briefly to VRS's defined contribution plans. VRS also manages defined contribution plans for state and local employees. Assets in those plans are completely separate from the VRS trust fund. Defined contribution plans are similar to private 401k plans or personal IRAs. Each participant essentially owns their own personal account and is responsible for choosing their own investments. Some of these plans are intended to be a primary source of retirement income. Examples of that would be the hybrid plan and then optional plans like the higher education plan. Others are intended to provide supplemental income, and so examples of that would be the deferred compensation plans that are used by many state employees. In total, the defined contribution plans held $7.7 billion in assets as of March 31st. Now, one way to evaluate the investment performance of defined contribution plans is to look at the performance of the various options that people can choose. As you can see here on this slide, the defined contribution plans, or options, I should say, generally exceeded their benchmarks. The only exception was for the 1-year period where majorities of the target date options and the higher education plan options missed their benchmarks. That was largely due to something called fair value pricing, which is just a way of pricing international funds to account for the differences in when markets close in various parts of the world. When the markets are volatile, as they certainly have been in the last few months, that pricing methodology can cause essentially temporary differences between the investment options performance and its benchmark. More importantly, over the longer term, those options are expected to track their benchmarks. And I'll move on to the last section of the presentation related to recent legislation. As you know, Madam Chair, there were several provisions of the 2022 Appropriation Act that were related to VRS. One of those set the contribution rates that employers will pay for VRS plans. The General Assembly elected to maintain the higher rates from FY21 and 22 and keep those for the upcoming biennium. And so those rates are shown on the table in on slide 14. Maintaining those rates, higher rates, could result in as much as $500 million in savings for the teachers plan over the next 15 years and nearly $50 million for the state employees plan over that same time period. One other good news story for VRS, the Appropriation Act also includes up to $1 billion in general funds to reduce unfunded liabilities of state and local plans. $750 million was paid at the very end of fiscal year 22, and the bulk of that went to the teachers and state employees plans. Another $250 million would go to these plans by the end of fiscal year 23, and that's if revenue collections in FY22 exceed the official estimate. If all of that happens, the full $1 billion contributed to the trust fund could result in as much as $2 billion in estimated savings for VRS over the next 20 years. Madam Chair, that's the end of my presentation, but I'm certainly happy to answer any questions.
Are there questions?
Madam Chairman,
Yes, Senator Norman.
perhaps it's an imponderable question, but I noticed that you said the return as of March the 31st was 12%. Do you have any idea about the decline that has taken place between March and today?
I think that's probably something that VRS investment staff could probably speak to and give you some more updated returns.
If VRS, the CIO will provide some more updated return information when he's up in a few minutes.
I think in the
It's
NFL, they call that a lateral. Thank you.
Any other questions? Okay.
Thank you,
Thank you,
Madam Chair.
Jamie.
Thank you, Jamie. Madam Chair, next you will receive the findings of an actuarial audit of VRS, which was conducted by JLARC's actuarial consultant, Gabriel Roder-Smith, or GRS. It's a little confusing, VRS and GRS. JLARC is required to conduct an actuarial audit of VRS every 4 years to assess whether the system is actuarially sound. To be clear, this is not the only actuarial assessment of VRS. VRS's own actuary conducts evaluation of the system every year. But the audit provides an independent assessment of the actuarial soundness of the system. So at the risk of stealing our actuary's thunder, the audit's findings were pretty positive. The audit found that VRS is actuarially sound and that the actuarial assumptions are generally reasonable, including the long-term rate of return assumption of 6.75%. So next I would like to introduce Lance Weiss and Amy Williams, who are the actuaries that conducted the audit, and they will be providing you a summary of their findings, and they will also be presenting to you virtually from Chicago.
Well, good morning, everyone. Good morning, Madam Chair and Commission members. My name is Lance Weiss, as Kimberly mentioned. I'm joined by my colleague, Amy Williams, and we are pleased to present our report on the 2022 quadrennial actuarial audit of the Virginia retirement system. I'm going to share my screen and pull up the presentation. All right. Here we go. So we'll turn here to the agenda. Just to give you a quick idea, we're going to very quickly go through background and the purpose of the actuarial audit. We'll talk about the actuarial audit process, and then Amy Williams will present the conclusions and recommendations from our audit. In terms of the background and purpose, the purpose of it is in accordance with the Virginia Retirement System Oversight Act. As Kimberly mentioned, Gabriel Roeder Smith and Company, GRS, was retained by JLARC to conduct this 2022 quadrennial actuarial audit. The purpose of the audit is to provide the General Assembly with a comprehensive overview of what we call the actuarial soundness of the VRS. This audit was completed with the full cooperation of VRS staff and VRS's consulting actuary, Kavanaugh McDonald Consulting, and we appreciate their full cooperation and assistance very much. In terms of the process, we conducted what we call a non-replication actuarial audit. We addressed the following areas. We looked at the actuarial assumptions to determine the reasonableness. We reviewed the actuarial methods and the funding policy of VRS, again, to determine its reasonableness. We looked at the actuarial assumptions and benefit plan provisions to determine if they were applied to the valuation appropriately. We reviewed the reports, the actuarial reports that were presented to us for their content, detail, format, and clarity. And certainly, last but certainly not least, we reviewed the calculation of the contribution rates and funded ratios, very important conclusions. And finally, we looked at the actuarial principles and practices employed by Kavanaugh McDonald Consulting to determine if they were in accordance with the actuarial standards of practice. The actuarial audit included a review of the following VRS programs. We reviewed the state plans, which covered the following divisions: the state employees, teachers, state police, judges, and Virginia law officers. We also reviewed 6 select political subdivision plans participating in the VRS, and those 6 were recommended to us by JLARC. They were picked by JLARC. We also looked at some of the health and welfare programs, including the health insurance credit program, the group life insurance program, Virginia sickness and disability program, the Virginia local disability program, and a new program that we looked at this year was the Line of Duty Act program, or LODA. I'm going to turn this over now to Amy, and she's going to talk about some conclusions and our recommendations. Amy?
Sounds like Amy might be muted.
Yeah, Amy, are you muted? No? I can't hear you. Can anybody hear Amy?
We cannot hear Amy in the meeting.
All right, I'll pick it up. No problem. So as Kimberly hinted to you and took away all of our thunder, the audit confirms that VRS is actuarially sound. This is really good news. The actuarial assumptions and methods used for the June 30, 2021 actuarial valuations are generally reasonable, and this includes the most important assumption, the 6.75% investment return assumption, which we deem to be also very reasonable. Based on our review of 94 sample test lives, we agree that Kavanaugh McDonald Consulting, or CMC, appropriately applied the actuarial assumptions, methods, and plan provisions. And also the June 30, 2021 actuarial valuation reports prepared by CMC comply with the actuarial standards of practice. So this is all very good news. We also looked at the funding policy that VRS employs. We believe it's very reasonable. It includes the unfunded actuarial accrued liability, which as of June 30, 2013, was being amortized over a closed 30-year period. That means each year the amortization period goes down 1 year. So now there are 22 years remaining as of June 30, 2021, and they are being amortized, as I said, over this closed 30-year period, 22 years remaining as a level percentage of payroll. The annual changes in the unfunded actuarial accrued liability after June 30, 2013 are amortized over separate closed 20-year periods. So now you've got separate amortizations between 13 and 20 years remaining as of June 30, 2021. And I should mention that the June 30, 2021, that is the most recent actuarial reports that we've reviewed. The June 30, 2022 reports are not available yet. They're probably going to be prepared soon. And the contribution rates that are representative from the funding policy are reasonable as well. Now we turn to the funded ratios. The funded ratio is the ratio of assets to liabilities, and the funded ratios are generally improving and moving towards a 100% funded ratio. The combined funded ratio for all of the VRS pension plans is 79.4%, just short of 80%. And that includes, that is as of June 30, 2021. That includes state employees, teachers, state police, judges, Virginia law officers, and political subdivision plans. We've got some recommendations, and we want to just caveat this by saying none of the following recommendations are the result of any material deficiencies. They are solely provided to improve the measurement and communication of future actuarial valuations. In terms of our recommendations, the payroll growth assumption, it's one of the actuarial assumptions that are employed each year. We believe that VRS should review the payroll growth assumption between experience studies to ensure that the assumption remains appropriate given changes in total payroll and the number of active members. And what we found was that total payroll has increased on average by less than the current assumption. The current assumption is that payroll will grow 3%. What we found is that total payroll has increased on average by less than the 3% over the 9-year period from 2012 to 2021, as well as over the 5-year period from 2016 to 2021. And the implications of it growing at a slower rate are that the contribution rate as a percentage of pay could increase over time. And again, we're not recommending that any changes in assumptions need to be implemented now or prior to the next experience study, but we would believe that, you should be reviewing it and making sure, what direction it's going each year. In terms of the funding policy, we have a recommendation here. We believe that VRS should consider the implications, which means increasing contributions, of having separate unfunded liability amortization bases. As I mentioned, each amortization base since 2013 is amortized on a separate decreasing 20-year or closed 20-year basis, and that could cause increasing contributions. So we believe that VRS should consider the implications and the magnitude of the expected change in future contribution rates as a result of maintaining these separate amortization bases. And our last recommendation is perhaps to consider actions to achieve a minimum net amortization charge for each plan that's not less than the payment required under a single 20 or 25-year amortization layer. And I know this is somewhat confusing, but these are our recommendations, and the actuary will take this into account as well as VRS. In terms of the report, we think there's some room for providing more details in the VRS funding report. We would like to see a better description of the technical assumptions. We'd like to see the basis for the early retirement reduction factors explained in the report. And again, we'd like to see an explanation of the implications of having these separate unfunded liability amortization bases. We'd like to see that in the report as well. We believe all of these recommendations will provide more communication and clarity of what's actually happening with the VRS plans. And that's it. That's our report, our recommendations, our conclusions. As I mentioned earlier, it's a very good report. Everything is really well done, and the plans are actuarially sound, and we're happy to answer any and all questions at this point.
Thank you, Lance. Are there any questions? Yes, Delegate Knight.
Yes, sir. You talk about the contribution rates. When we have the least amount of our state employees are going to get 5% and 5%. And then we've got some starting salaries upwards of 22%. And we've got some other categories that are even more than that. I want to know if that plus the $1 billion that we put in it this year, I'm thinking it probably won't need to up the contribution rates anytime soon. And also that 79% is probably maybe be close to touching 80% in a year or so. And if that's the case, what do our bond rating agencies like to see? Because it probably isn't realistic to think about 100%. You're kind of wasting your money if you're at 100% rate. So it's kind of a three-part question, but I didn't know if you could kind of put it in context for us.
Well, I can try. There were a lot of questions there. From a bond rating, agency perspective, I can't answer that. I can tell you my impressions of what the bond rating agencies, like to see, but it's again only my, impressions. Generally, they do like to see increasing funded ratios. So they want to see that funded ratio continuing to grow and increase towards 100%. That is definitely something they like to see. At 79.4%, just short of 80%, that's certainly not bad. I think you're, in terms of average funded ratios for plans around the country, probably closer to 70%. So, you're above that. But again, rating agency generally like to see an increasing funded ratio, trending towards 100%. Again, my opinion only. Let's see, what else did you ask? What other questions?
What I asked was the extra contribution of $1 billion, plus knowing that the contribution rate is going to go up by virtue of state employees and teachers getting a raise.
Yeah, I think you're in good shape. Overall, we believe that the plans are actuarially sound. We believe that the funding policy, which kind of guides all of this, is reasonable. And, we think that you will be getting to, trending towards 100% funding. So yes, everything looks good in the future. Now, again, that's dependent on the investment market. If you all of these fluctuations in investment returns, the volatility of the market, that could put a kink in things. But assuming that you do earn over time the 6.75% investment return assumption, we think everything's looks good for the future.
Delegate Wilt.
Thank you, Madam Chair. So on page 10 of the presentation, under the recommendations, I'm curious if you could maybe flesh out just a bit more your recommendation on the amortization base. And I guess my question is, so there was multiple ones previously. I'm wondering why it was done like that. And then what's the advantage of consolidating those bases?
So I turn back to page 7 because this kind of tells you, what the funding policy is. And this is the VRS funding policy. I think, perhaps VRS could probably answer more in terms of why they did this, or the Kavanaugh McDonald could potentially answer that. But as of June 30th, they cut, all the entire unfunded liability. They determined that it should be amortized over a closed 30-year period. And now there are, 22 years remaining. So that total as of June 30, 2013, whatever is left is now being amortized over 22 years. Any changes in the unfunded actuarial accrued liability after June 30th? So for example, the June 30th, 2014 valuation, if there was a change in the unfunded, that change, whether it's a positive or negative, is amortized over a 20-year period starting June 30, 2014. So now, you've got 20 years, and so now it's 13 years left. The June 30, 2015 valuation, whether there were changes in that, in the unfunded at that point in time, that was then being amortized over a 20-year period. So now it's probably 14 years, and subsequent, unfunded liabilities each and every year are amortized over separate 20-year periods. Again, I can't answer why this was done. As I said, perhaps VRS and or Kavanaugh McDonald can answer that. This is a fairly common method of amortization for unfunded liabilities. But at that point, I would hope that VRS and or Kavanaugh McDonald could provide more detail on why this was, why this specific amortization policy was employed.
Delegate Wilt, does that answer your question, or would you like VRS or Kavanaugh McDonald to further expand?
I guess the short answer is from a liability standpoint is.
I think your question is why did they switch to this amortization
Well,
methodology?
and why would he recommend changing, if I'm understanding the recommendation? That's it.
My recommendation, let's go back here to 10. Based on the amortization policy, this separate unfunded liability amortization basis, there could potentially be increasing contributions in future years. And so what we're saying, our recommendation really is just to review this. What are the implications of these separate unfunded liability bases? And, are there potentially increasing contributions coming in future years? And what is the magnitude of these changes in future contribution rates? And so our recommendation is not necessarily to change it, but to look at it. And, if there are potentially increasing contributions, consider the implications. And also, what is the magnitude of that change in contribution rates? Generally speaking, we like to see contribution rates that are level as a percentage of pay into the future. But because of this specific funding policy, those contributions there may be more volatility because of this funding policy. And so we're just saying, take a look at it. That's really our recommendation, is just take a look at it, make sure that you understand it, and make sure that, you're not surprised by these increases in contribution rates that may occur in the future. That's all our recommendation is.
So reevaluate after future actions.
Further questions? I don't see any. Thank you, Lance. It's wonderful to hear so many superlatives about our VRS system. I've been here 30 years, and it hasn't always been that way. I can remember way back when, 28 years ago or so, when there was excess funding, what was called excess funding in VRS, and the great idea was to take it, put it in the general fund, and spend it on recurring programs. So I'm so glad we've moved beyond that and recognized that this is really a trust that we have for the employees of Virginia and our localities, and we treat it with respect. So thank you again.
Thank you all.
Right. Thank you again, Lance and Amy. So, Madam Chair, I did just want to mention that there are letters from both VRS and its actuary, Kavanaugh McDonald, in the back of the report indicating that they're pleased with the audit's findings and that they concur with its conclusions, not surprisingly. So next, VRS will be providing you with their annual status report. First, the board chair, Mr. Scott Andrews, will provide some opening remarks. And after that, Mr. Ron Schmitz, the CIO, and Trish Bishop will be providing you with their remarks as well.
Mr. Andrews.
Good morning, Madam Chair and members of the Commission. I'm Scott Andrews, Chair of the VRS Board of Trustees. Having been sworn in this spring, I'll offer a quick introduction. I was born in Richmond and am proud to be an alumnus of the University of Virginia, just one of Virginia's many high-quality public universities. My wife Jennifer is a former teacher with the Fairfax County Public School System, and we know firsthand how important and essential the services provided by VRS members are for all Virginians. My professional career included time with J.P. Morgan in New York and San Francisco. However, I've resided in Virginia for the past 37 years during my finance, investment, and executive management career. Currently, I am Chairman and Chief Executive Officer of Northern Contours, a manufacturing company where I have had board and executive oversight since 2005. I'm honored to serve the Commonwealth's public employees and view my role as chair and board member as a true privilege of service to our member beneficiaries. Apart from my appointment as chair, the VRS Board of Trustees membership has remained unchanged over the past year. Overseeing the portfolio and the administration of benefits for VRS members and retirees is significant and humbling responsibility for us all. I look forward to working with my fellow board members and you in this endeavor. Just as all of us here count on VRS members to provide public services and perform essential duties across the Commonwealth, more than 750,000 VRS members and retirees count on us in return. We remain fully mindful and diligent of our fiduciary duty to the Commonwealth's teachers, local government workers, first responders, and state employees. As VRS celebrates 80 years of continuous service to our members, we now stand as the 17th largest public or private pension fund in the U.S. and the 46th largest in the world. VRS members work for 835 unique employers across Virginia. VRS's highly diversified investment strategy and strong support from the General Assembly and administration help keep contribution rates steady for those employees. As noted by the JLARC staff earlier, your continued and demonstrated support in this year's budget includes 2 significant infusions to help pay down unfunded liabilities, and you maintained contribution rates for the coming biennium to further demonstrate your commitment to the plan. Additionally, plan design changes over the past decade have reduced the future cost of benefits and introduced a shared risk model, the hybrid retirement plan. Together, all these actions have long-lasting positive effects, enabling VRS to support members well into the future. Combined with our assumed rate of return, which we revised after careful consideration in 2019, VRS's funded status is in solid position. Our director, Trish Bishop, will share more about this shortly. Since we're only a couple of business days beyond the June 30th fiscal year end, we are still receiving data from managers, and it's too early to provide a solid estimate of a final return at today's meeting. However, given market volatility, returns will be more muted. We will share that number with JLARC as soon as possible. Our Chief Investment Officer, Ron Schmitz, will discuss returns and describe the strong progress we saw in fiscal year 2021. The fund maintains its historic high asset level of more than $100 billion. The largest portion of our retirees' benefits are funded through investment returns. About 2/3 of the benefit comes from investment earnings. The VRS investment team is fully aligned in decisions made today that they must support the current and future needs of its members. This is precisely why VRS focuses on performance over the long term, 20 to 40 years, not simply a single year. By balancing risk with reward in our diversified portfolio, the VRS fund is projected to grow steadily, meeting or exceeding the assumed rate of return over time. Active management by VRS's investment professionals continues to provide added value to the fund. As of March 31st, this amounted to an average annual value add of approximately $660 million. That's an additional $6.6 billion over a 10-year period that would not be realized if the fund was simply invested in a passive indexed portfolio. Similarly, VRS administration provides value to members and retirees. The most recent yearly study conducted by CEM Benchmarking reported that VRS delivers a higher level of customer service at a lower cost compared to the group average of 69 leading retirement systems in the U.S., Canada, and other countries. One advancement, excuse me, where VRS is already seeing efficiencies in last year's launch of online retirement through MyVRS. So far, more than 3,700 members have submitted their retirement applications online, and that number is growing every day. MyVRS now offers several online customer service features such as updating beneficiaries, direct deposit, and health insurance information, which has the advantage of being both faster and more secure than paper forms. VRS is an early leader in online retirement technology, with only 2 other peer pension plans currently offering a true online retirement experience, according to CEM benchmarking. And once members retire, about 86% choose to remain in Virginia. VRS paid $5.5 billion to retirees in fiscal year 2021. They spend this retirement income in their communities, boosting the state and local economies. On behalf of the VRS Board of Trustees, thank you for your continued support of the retirement plans and other benefits administered by VRS for the Commonwealth's public servants. Now, before I introduce CIO Ron Schmitz, some of you may know that he is retiring at the end of this year. I've had the honor to work with Ron for just a brief period. However, I know that his stewardship of investment operations has been of immense benefit to VRS, its staff, and our beneficiaries. Thank you, Ron, for your excellent leadership in shepherding the assets of VRS. I'm pleased to share that we recently completed an extensive national search for our Chief Investment Officer. Throughout the search process, our consultants repeatedly noted that this position and the reputation of the entire VRS organization were held in the highest regard by the candidate pool when assessing other state public pension organizations. As noted in the JLARC staff presentation, we're delighted to announce that Andrew Junkin will join us in September. Andrew has demonstrated vision and skill as an investor in both the public and private sectors. He joins VRS from Rhode Island, where he serves as the Chief Investment Officer, managing a team that oversees the state's pension plan, defined contribution plan, and other funds. Previously, he was with Wilshire Consulting for 15 years and served as president for his last 5 years there. Ron will work in tandem with Andrew for a period leading up to Ron's retirement to ensure a seamless transition of the investment team's leadership. I greatly appreciate this opportunity to address this commission. Now Ron will provide an overview of the investment program. Thank you.
Thank you. Thank you, Mr. Chair. Good morning.
Good morning. Thank you, Chairman Andrews. Good morning, Madam Chair and members of the Commission. It goes without saying, I guess, that I'm Ron Schmitz, Chief Investment Officer, at least for 6 more months. I'm pleased to be here today to present the annual VRS Investments Report, which for the year is a bit more of a mixed news story than it was last year when things were just skyrocketing upward, it seems. It's certainly been a more challenging year in the markets than last year when we had historical high returns, but as Chair Andrews said, we're still above $100 billion, and I'll talk a little bit in a few minutes about the expected fiscal year return, which is very much still an estimated stage at this point. As usual, I include in my discussion outline of the slides. Many of these I can kind of cover pretty quickly. Others will take a little bit more detail. But first, as we always do, we start out with the bars just represent annual fiscal year returns on this graph, and you can see that they vary quite a bit, usually positive, but sometimes negative, every once in a while painfully negative. And then the solid line across the solid line going horizontal across represents the assumed rate of return, which if you look closely has kind of trended downward a little bit from 8% to the current 6.75 that's been alluded to previously by other speakers. I would comment that the We are not alone. Virginia has kind of led the way, I think, in reducing the assumed rate of return starting 10 years or so ago. Other states have followed suit. The median rate of return assumed by our pure public funds is 7%. So we're just a little bit below the median, and we think that that's a proper place to be. Here's a little bit more traditional way to look at long-term performance for various periods ending 3/31. As you look at the annualized performance over the last 15, 20, and 25 years, you'll see that the portfolio returns are actually pretty close to the assumed rate of return. You have to remember, though, as I said earlier, that the earlier years, the assumed rate of return was 8% and has declined steadily since then. But I think that this shows, if you look at the longer-term returns of both the benchmark and the fund, you can see that it indicates that the 675, while a bit conservative perhaps, is a realistic number. Here's the total fund performance at 3/31. Jamie shared these results with you, I think, in terms of the total fund. Here we break it down by the different asset classes and different buckets. Looking at the total fund rows highlighted in yellow, you can see that the fund performance has outperformed the board-established benchmark in each period. Further, returns over the past 12 months are very strong compared to the benchmark, most notably those generated by the private markets. As a point of reference, the outperformance target established by the board with input from an external consultant has historically been 30 to 60 basis points. That's 0.3 to 0.6% above the benchmark. Due to a recent study by a consultant looking at benchmarks and hurdles, the board made some changes to some of the individual asset class benchmarks based on conditions, changes in strategy, and in some cases just changes in the investment world where different benchmarks are available. The board has made a change in the total fund benchmark. Our outperformance goal now is 45 to 90 basis points, so it's been elevated a little bit from the history. We do have an update here for 4/30. This is the most recent and the latest reviewed set of numbers that we have. I'll talk in a second about May and June. This is through April. Unfortunately, due to our early meeting date, we don't have final May numbers, but it looks like the month of May was roughly flat, a slight positive. June has been pretty negative. The stock and bond markets were down high single digits. We do expect some positive numbers from the private market assets, but I don't think it'll be enough to greatly offset the public market decline that we've seen in the recent few weeks. So we'll fall, fairly well short of the 675 assumed rate of return from this year. But again, I would remind you, last year's 27.5% return gives us a lot of wiggle room and a lot of ability to absorb a disappointing year like this year. If I could draw your attention to the 1 year and fiscal year to date columns, just kind of broadly speaking, stock and bond returns are weak given the rise in interest rates, but value has been added pretty significantly by staff in their implementation efforts in those asset classes. Private markets, especially private equity, have been quite strong on both absolute and relative basis. As a reminder, the private market assets are not marked to market in April, so this is slightly underreporting what I think the performance will be at June 30. And then last but not least, the multi-asset portfolios have done well in both private and public market sectors. I wanted to comment a little bit, just give a little more color. Jamie correctly noted that at March 30, the public equity portfolio had underperformed its benchmark across all the periods shown. And I certainly don't dispute that. That's an accurate report. But I did want to provide a little more color. If you see it, looking at the top part here, if you look at the month of April, what a difference a month makes. We can see that the fiscal year and the 1 year number are now ahead of benchmark. The 10-year number is now equal to the benchmark. That's really basically because the month of March was a tough month. We underperformed, the portfolio underperformed by about 1%, whereas in April it flipped and we outperformed by about 1.5%. And just that little bit of a swing can change the numbers quite a bit. But what I really wanted to talk about to give more color on that is that the time period that caused difficulty was that 2018 to 2020 period with COVID. If you looked at the 10 years prior to COVID, from the great financial crisis through 2017, we had 10 years in a row of outperformance in the public equity portfolio. During the COVID years, 5 or 6 technology stocks completely drove the market, and everything else lagged significantly compared to those stocks, and that was the case for us as well. We tend to like value and quality stocks, and those just weren't the ones that were doing quite as well in that environment. Since late 2020, when the vaccines were announced, the availability of vaccines were announced, the market leadership has turned in terms of the types of stocks now being rewarded. And in fact, in the recent downturn, growth stocks and technology stocks have been hit harder than the market in general. And our stocks, the quality stocks and stocks that have better value characteristics, are doing better. We think that's a dynamic that'll last for several years to make up for that very difficult period in 2018 and 2020. Moving on from performance to asset allocation, all the asset class exposures are within board-established ranges. The key risk parameters in terms of volatility and statistical variation from the board policy are also within the pre-approved levels. That said, public equity is presently near the lower limit of its allowable range, while private equity is near the upper limit of its allowable range. Combined, the two high-risk return asset classes are an aggregate equal to the policy benchmark, but there's a disparity between the two individual asset classes. That was largely intended by staff, although it's been augmented a little bit by market action in the past year or so. As has historically been the case, the VRS portfolio is broadly diversified, even though its largest asset class is public equity. There's meaningful exposure to other types of investments. This diversification has been advantageous in the long run and has been particularly beneficial in the last year as the economy comes out of the COVID lockdowns and the market reacts to the Fed's efforts to quell inflation. I wanted to share a little bit of information. I think I shared a version of this graph with you last year for the first time. And it shows how VRS is positioned with respect to risk and reward compared to other funds and to the market, broadly speaking. So to set up the graph, please note that the thin line that goes from the bottom left up toward the top right has two levels of significance. First, it's the upward sloping line is a regression line that encapsulates the outcomes from all of our peers. We don't have the individual peer plots, but if we did, there'd be dots up and down around that line. So that's really a regression line of best fit of what our peers have done. But it's also, and this is not illogical, it's also a capital market line. The bottom left is lower risk, lower return, bond-like investments. As you move upward to the right, it's more equity-like and higher risk portfolios. The upper left quadrant is shaded in green. That represents portfolios that are generating more return at less risk than the peers in average and then what the capital market line would imply. And VRS thankfully falls into that category, both in terms of its benchmark, and as you can see, the total fund is outperforming the benchmark a little bit at just about the same level, slightly less levels of risk than the benchmark. So all in all, I think a good statistic here. The board, I think the commission always likes to know what changes the board has made in terms of asset allocation policy, and as I think you're all aware, we've been over time for the past 10 years or so slowly shifting from a portfolio that was largely public in terms of stocks and bonds with some exposure to private market assets to increasing the private market asset exposure over time. Each year, come a June meeting, effective July 1, the new fiscal year, the board adopts a new policy. The first column of numbers here is the fiscal 2022 policy that we're just coming out of. The next column represents the changes for 2023. Basically, as you look at this, you can see that we've increased or decreased public equity 2%, and that's accordance to the trend that the board had adopted many years ago in its asset liability study. And we've increased private equity by 2%. As you look at the long-term policy target, we see that the multi-year phase-in that we've been undergoing for several years now has just about gotten us to where we want to be. We still have a little way to go to building up the multi-asset exposures, but progress on those will take time as we want to make sure that the strategies are proving their merit and they're still relatively new, so we're being cautious in increasing exposure to those, even though the long-term policy target calls for increased exposure. Last, I should say that the board will likely undertake a formal asset allocation study this in next fiscal year, probably in the spring. It's been 3 years since the last formal policy, and that's been the cycle we've been on every 3 years. This is done historically has been done with an outside consultant. And it's a good time to do it with a new board chair, a couple of new board members that joined a year or so ago, and as obviously a new CIO, as the chair mentioned. So the timing of our normal asset allocation reviews is very good. The commission always wants to hear a little bit about internal asset management, so we've got some slides on that. The internal asset management portfolio is concentrated in public markets, fixed income, and stocks. The bulk of the bonds managed internally are core investment-grade securities. There's a small allocation of assets to non-core areas of the bond market, namely high-yield and emerging market securities. Some of those non-core assets are also managed by external managers, but the bulk of them are managed internally. Looking at equities, about 60% of the internal equity management activity is in low tracking error strategies, which means that the portfolios are managed with a slight ability to tilt exposure to individual stocks, as well as economic sectors to add value. About 25% of the assets are in low volatility strategies, which really focus on high quality companies and value companies. And lastly, about 15% of the equities are managed in real estate investment trusts, and that's through a combination of low tracking error strategies and pure indexing for the global part. All three of those buckets that I mentioned are global in nature. They're not just US only portfolios. All told, about 30% of the total fund is managed in-house under traditional stock and bond management. This percentage has dropped a little bit from earlier years for two reasons. First, as I mentioned, there are a couple of external managers now in fixed income that didn't used to exist, so that reduced the amount of bonds managed internally just ever so slightly. But the biggest factor is the move from public markets to private market exposures, and that significantly reduced the amount of stocks that are under management, and therefore the amount of internal management. Basically, there's about a 40% to half of the portfolio, equity portfolio, is managed internally, and the other by external managers. Here's the track record for both the stock and bond internal portfolios. In terms of performance, the fixed income team has consistently added value over its benchmark. And indeed, the team regularly exceeds expectations through its risk-controlled approach. The equity portfolios has good longer-term numbers. And again, this is just the internal equity piece, not the total public equity program. In the aggregate, the team has added value in the 1, 10, 15, and 20-year period. The 3 and 5-year period have been hurt a little bit by the same factors that I mentioned earlier that hurt the public equity portfolio, namely that tech stocks drove the market, and we tended to be underweight those stocks. And again, as I mentioned earlier, that's seen a nice turnaround, and the internal equity team has bounced back very strongly in the last year or so since the vaccines were announced in late 2020. There are other ways that staff adds value that I always like to highlight beyond just the internal management. First, if you look at the top left quadrant of the slide, this is simply a performance-based report. Chair Andrews mentioned this before. $660 million a year, $6.6 billion over 10 years has been added through performance above benchmark. If you look at the top right, excuse me, this is the light green and the light blue wedges are traditional implementation of public and private market strategies, respectively. The dark blue wedge represents in-house managed assets, and the dark green is private market implementation with co-investment and other fee-advantaged investment structures. The bottom two portions of the slide are provided by CEM, Cost Effectiveness Measurement Benchmarking, an outside service that measures and shares information among various pension funds globally with respect to investment and administrative functions. CEM calculates that the in-house management saves VRS $61 million in fees that would ordinarily be paid to external managers, and that our implementation of the external manager fee structures, i.e. we pay less than what our peers pay, saves an additional $40 million, almost $41 million a year. I should note that the timing of these two graphs are slightly different. If you look closely, the value add, total value add in the top left quadrant is a 3/31/22 calculation based on the most recent performance. The CEM data is a bit dated. That's calendar year 2020. They're in the process of updating their 2021 surveys, and we'll have new information on that shortly. So last, I'd like to just close with a few comments about the market and the economy, which is JLARC staff has asked me to do. There are many cross currents at play in the economy and the markets right now. Key questions weighing on investor sentiment are the course of inflation, which is still highly uncertain and it's been stubborn. I think last year I probably used the word transitory as Chairman Powell had used, and we've certainly moved beyond transitory to something that's been more lasting. We are starting to see some signs of inflation abating a little bit, but it's been a slower and more difficult process than anticipated, and we're not out of the woods yet there. Earnings is the other big piece. The Wall Street analysts are still fairly bullish in their forward earnings outlooks. We are, however, starting to see CEOs and CFOs, when they do their quarterly earnings announcements, add some cautionary notes in their forward guidance. So we'll be watching earnings closely to see if we're heading into a recession or not. I think generally speaking, the public equity markets have repriced themselves given the higher interest rates as the Fed has raised rates. But they've not completely repriced a fall in earnings. So if we do start to see a decline in earnings from the projections, we're likely to see some additional stock market difficulties. On the positive front, labor and housing markets are doing really well, which tends to feed buying power for consumers. And on the negative front, the war in Ukraine continues to have challenges regarding energy and food prices. The odds of a recession today are higher than they were just a few months ago. Most pundits have it at 50% or a little better. A few more optimistic ones are still in the kind of 40% range in terms of their expectation for a recession in 2023. The last slide is just kind of a summary of all I've said thus far. I'll try to hit the points real quick. Returns are a bit more mixed this year than last, obviously, but will be low single digit versus last year's 27.5%. Still, the markets and economy continue to recover from the impacts of the pandemic, though at a less frenetic pace this past year than had been the case a year ago. Relative performance is still solid. In fact, I think we're generating our best relative performance to benchmark that we've seen in 10 or 15 years. So we're really pleased about that. And we do think that the switch in the value rotation in the public equity markets will continue to be a tailwind. In a year that's been flat to marginally positive, staff value add has been at much higher levels than normal. Sorry, that's a little repetitive. I jumped ahead of myself earlier. The board is continuing its measured pace of phase-in of the long-term policy target. As mentioned, there'll be an asset liability study this year that could see some slight changes in the long-term policy, although the last two studies really basically just validated the 2012-2013 study that we've been working under and just modifying slightly. So I thank you for your kind attention. I'm happy to take questions, if any.
Are there any questions for Mr. Schmitz? Not seeing any. I'd like to take the prerogative of the chair just to make a few comments. As you've just heard, Ron is going to be retiring at the end of this year. And since this is the last JLARC meeting on which he will be presenting, I did want to make a few comments. He joined VRS as Chief Investment Officer in October 2011 from the Oregon Public Employees Retirement System. During his VRS tenure, he made many contributions to the system, but I want to highlight just a few. Notably, during Ron's tenure at VRS, the VRS Trust Fund almost doubled in size from $51 billion in 2011 to over $100 billion for the first time last June. The VRS Trust Fund experienced an outstanding fiscal year in 2021, generating a 27.5% return. Oh, how I wish mine was that good. A record level of fiscal year performance that's not been seen in the past 30 years. Ron has been instrumental in leading the value add contributed by staff to the fund. Over the last 10 years, staff value add equated to more than $6.6 billion in the portfolio that would not have been there under a passively managed approach. Stated another way, Ron's leadership resulted in $660 million a year coming from strong relative performance at the total fund level. Ron has also kept his eye on reducing fees. As was mentioned a couple minutes ago, the CEM, an international pension fund benchmarking service, calculates that in-house management saves VRS $61 million a year that would otherwise be spent on external manager fees. Ron also ensures that his team deploys best execution in transactions and VRS's implementation efficiency under Ron's leadership, that is paying less for services than what peers pay, saves VRS almost $41 million a year. Ron, we truly appreciate your service to the Commonwealth, your dedication to the fund, and your commitment to VRS members and beneficiaries. We commend your ability to leverage your experience and leadership skills to develop strategies that have enabled the growth of the fund and the maximizing of investment returns while minimizing the risk. Please join me in passing along our thanks to Ron and best wishes for a wonderful retirement, even though it's still half a year away.
Thank you very much. Appreciate it.
Okay, next we will hear from Trish Bishop, who's the director of VRS.
Thank you, Madam Chair. Good morning, members of the Commission. Thanks for the opportunity to share a brief update on VRS with you. At VRS, we are incredibly proud to serve the Commonwealth's public servants. During my remarks this morning, I'm delighted to share an update how we carry out our mission. So I'll begin by sharing some overall highlights that have been sort of discussed a little bit, of course, through the course of Jamie's remarks as well as the chair's remarks and Ron's. But these highlights kind of talk a little bit about the current status of the plans. I'm pleased to share that thanks to the ongoing commitment of the General Assembly and the Governor to maintaining budgetary efforts and supporting the contribution rates, the health of the plans has substantially improved. Further, maintaining contribution rate levels from the prior biennium for the state employee and teacher plans and furnishing the one-time infusions, including the $750 million VRS received just prior to June 30th, provides additional funding for the plans, addresses legacy unfunded liabilities, lowers future contribution rates, reduces future rate volatility, and generates long-term savings. To illustrate, we estimate that the $750 million infusion will generate a cost savings of $1.4 billion over the next 20 years and improve the funded status of the plans by about 75 basis points. Further, through your ongoing efforts, the funded status of the plans has continued to improve. Paying the required contribution rates and accelerating funding, along with positive investment performance, has resulted in the plan's funded status improving by about 10% over the last 5 years. Although unfunded liabilities still remain, we're making considerable progress reducing those liabilities. For example, unfunded liabilities decreased from about $26.7 billion on a market value of assets in 2020 to $12.2 billion on a market value in FY 2021. As the Chair and Ron noted, the portfolio experienced an exceptional 2021 return, and the 2021 returns will serve to mitigate the impact of future market fluctuations on contribution rates. Finally, the additional contributions that have been provided, including the one-time infusions and maintaining the higher funding levels for the new biennium, will serve to bolster the funded status. As noted previously, with 2/3 of benefit funding coming from investment income, the commitment to fully fund contribution rates and accelerate funding allows VRS to capitalize on investment income generated from these contributions. And as we think about long-term plan costs, I should touch upon the impact of the hybrid retirement plan. The hybrid plan is becoming the dominant plan for most employees. It created a risk-sharing model between the employer and the employee. It reduced longevity and investment risk for the employer. It lowered the future cost of the plan because of its different age, service, COLA, multiplier provisions, and these savings are blended into the contribution rates over time. Finally, with the defined contribution portion of the hybrid plan, the plan increased portability for plan participants. So after that overview, I'll provide a brief touch upon membership briefly. This slide represents the 772,000 members we serve. We administer 3 plans, Plan 1, Plan 2, and the hybrid plan. Plan 1 and Plan 2 are essentially closed plans to new members, with the exception of those who are in hazardous duty positions. Those folks are generally covered by Plan 2. You'll note that the largest member group is our teacher group with about 158,000 active members, followed by political subdivision plans, about 110,000 members, and then all of the state employee plans, including state, Valors, JRS, and SPORES, make up about 83,000 members. The hybrid plan is quickly growing and has about 145,000 active members and now composes about 41% of the active VRS population. So switching gears, I'll turn now to funded status. It's a commonly used measure to gauge the health of a plan, and it is a ratio of the assets available to pay benefits compared to the plan's liabilities. Overall, the VRS pension plan as of June 30th was about 89% funded on a market value basis. And this shows continued progress and is a positive update for the fund. Drilling down a bit into the individual plans, this slide shows the funded status of the state employee plan. The blue bars represent the historical funded status. The green bars provide an estimate of future funded status using data as of June 30th, 2021, and assuming that annual investment returns are 6.75 in future years. The state's funded status as of June 30th on a market value was 86.5%. Over the last 5 years, on a market value basis, the state plan's funded status has improved by about 15%. One item to note here that the estimates in green don't include the $750 million infusion or the higher contribution rates for 2023-24, but if they did, the funded status would likely improve by an additional 75 basis points. So this graph shows the funded status for the teacher plan and follows the same general pattern as the state plan. As of June 30th, this funded status of the teacher plan on a market value was 86.5%. And here again, the last 5 years, the funded status of the teacher plan has increased about 17%. The political subdivision plans are shown here in aggregate, meaning that all of the assets of the plan are divided by all of those plans' liabilities across the 500 or so political subdivision plans that we administer. But keep in mind that individual political subdivision plans will have experience that may vary from this aggregated data. The funded status in aggregate here is generally higher than the state and teacher plans because the local plans have historically been required to pay the actuarially determined rates, so they don't have the same degree of the legacy unfunded liabilities experienced in the state and teacher plans. The political subdivision plans in aggregate were 97.8% funded as of June 30th, 2021. So let's turn now a little bit to talk about contribution rates. And due to the exceptional performance in 2021, the actuarially determined contribution rates for the upcoming biennium for the state and teacher plans would have been lower than the prior biennium. However, the budget this year maintained the contribution rates at the same level as the previous biennium, which improves plan health, lowers liabilities, and will generate savings over time. On the left side of this slide, you'll see the state plan in blue, which is maintaining the rates at 14.46%. which will provide an infusion of an additional $32 million into the state plan, and which should save approximately $48 million over the next 15 years. Maintaining the teacher rate, which you'll see in green on the right, at 16.62%, provides an additional $345 million into the teacher plan, and will generate savings of approximately $500 million over the next 15 years, and that $500 million will be split between general fund and non-general fund. So in addition to maintaining the contribution rates, and as noted earlier, we were incredibly gratified by the significant cash infusion provided in the Appropriation Act. Here you'll see that with the provision of the $750 million, the funded status improves by about 75 basis points and saves approximately $1.4 billion over the next 20 years. In addition to the $750 million, as Jamie mentioned earlier, another $250 million is contingent in FY 2023. While it's contingent, if provided, it will save approximately $509 million over the next 20 years. And you may recall that our other post-employment benefits, or OPEB plans, have lower funded status than our pension plans. And this is really due to the fact that over time they had been pay-as-you-go for a longer period of time, and so they had developed higher liabilities than our pension plans. They really weren't pre-funded. So they also experienced a number of premium holidays. So in light of the lower funded status of the state health insurance credit plan, the Appropriation Act specifically provides $80.4 million to the health insurance credit state plan, which will improve that plan's funded status by about 30% and save money in the process. And we estimate the savings associated that will be about $99 million over the next 20 years. So as we monitor the health of a plan from a funding and contribution rate perspective, we also closely monitor the ways to enhance service delivery and customer experience for our members. An example of putting the customer experience and information at our members' fingertips is our MyVRS system, which is a unified system that provides members with a variety of self-service tools to help them plan for retirement. It includes a goal-based retirement planner, member benefit profiles are automatically pull in their defined contribution plan balances, so they get a comprehensive estimate of their future retirement income. Additionally, there's a benefit estimator, self-service purchase of prior service. Folks can designate their beneficiaries, handle direct deposit management, and then do online retirement. Just a few words about online retirement. It's much more than digitizing a paper submission. We designed our online retirement functionality to be a comprehensive experience with embedded counseling. So wherever our members are in the Commonwealth, they can get the same robust experience, which is a big benefit in terms of extending our reach to our members. Our online retirement is a holistic and secure approach, and it does have built-in counseling to help avoid the no one ever told me scenarios. It includes videos and step-by-step guidance at key decision points. By providing intuitive self-service features and pre-retirement counseling, we're also streamlining administrative tasks for our members, staff, and employers. And when we're helping our members make these informed decisions, we are hoping to improve outcomes. About 3,700 folks have used the online retirement system since we went live with a soft launch in December 2020. And usage and the percentage of retirements continues to increase over time. And this allows us to focus more on the cases that are high touch and allows us to be more efficient. We've also added, as part of our holistic support to members, financial wellness, and this financial wellness tool has also been touted by our employers as an additional benefit for their employees. MyVRS Financial Wellness breaks down sort of overwhelming topics into bite-sized chunks, delivering engaging material in a way through short articles, videos, games, calculators, and graphics. It's constantly refreshed and helps our members boost their knowledge, which we see in pre- and post-test assessment. As members learn more about financial wellness, they're better prepared for their futures. Another area where we have added services for our members is in financial planning. We offer financial planning services in partnership with Mission Square Retirement. Mission Square is our third-party administrator for our defined contribution plans, but whether or not our members have an account with Mission Square, all VRS members are eligible to use this service. And the certified financial planner professionals offer guidance and support at no cost to our members for the first 30-minute session. So finally, I'll take just a moment to compare VRS's service delivery to our peers. In our view, what gets measured gets managed. We think our results are fairly compelling here. We work with CEM, which works with over 400 funds worldwide to provide benchmarking. According to CEM's benchmarking analysis, VRS pension administration cost falls $26 below the peer average, or stated another way, VRS is 24% below our peers in terms of plan administration cost. But obviously, cost isn't the only important measure. When comparing VRS to other peers, our service delivery score of 82 exceeds the peer median. Further, if we graphically plotted our cost and service, we'd be found in sort of the favorable northwest quadrant, where we provide a high level of service at a lower cost when compared to our peers. And we're proud to say that this has been a long-standing, cost-effective way of delivering service at VRS. As always, we're honored to serve the Commonwealth's public servants, and we continue to innovate in order to help our members plan for tomorrow today. That concludes my prepared remarks, but I'd be happy to answer any questions.
Thank you, Trish. Are there questions? That was quite a lot of information. I don't see any questions, so thank you very much.
Thank you, Trish. Madam Chair, next we will be switching to the Virginia 529 portion of the meeting. I should mention that we will not be presenting JLARC's main work this year on Virginia 529 today, and that, of course, is responding to the Commission's motion from last year, directing JLARC staff to look at whether the very large surplus in the legacy prepaid 529 program can be used to help increase higher education access and affordability. We will be presenting you with the results from that review this fall. Today, Jamie Bitts will be presenting you with the key findings from our biennial oversight report of Virginia 529, which is required by the College Savings Plan Oversight Act. And Madam Chair, I know we are a good bit behind schedule. Jamie has abbreviated his comments, and we would just ask the following presenters to do so as well, just to be mindful of your time.
Thank you.
Jamie?
Thank you, Kimberly, and Madam Chair, good morning again.
Good morning.
At this time, as Kimberly said, I'll present our biennial oversight report on the Virginia College Savings Plan, also known as Virginia 529. The report is required under the Virginia College Savings Plan Oversight Act, and the requirements of the act are just listed here on the slide. We submit this report to you every 2 years, and the topics that I'll cover this morning are just listed here on slide 3. Very briefly, state 529 plans are authorized by the Internal Revenue Code. They're tax-advantaged savings programs for education and then for individuals with a disability as well. This slide summarizes Virginia 529 savings programs. I'd point out that 3 of those programs are managed directly by Virginia 529. The largest of those is the Invest 529 program, followed by the Defined Benefit or Prepaid program. And then there are 2 national programs at the bottom of the slide that are sponsored by Virginia 529. Next, I'll talk about Virginia 529's education savings program, starting with that defined benefit program. Virginia 529 has 2 defined benefit college savings programs. One is the Legacy Prepaid program. That was closed to new participants in 2019, but it does still continue to pay benefits to account holders. And then the second program is the Tuition Track Portfolio, or TTP. which opened early last year. The defined benefit fund has a total of $3.1 billion in assets as of March 31st. That is a slight decrease compared to the previous year, but assets did increase by more than $500 million between 2020 and 2021. The defined benefit fund is spread across 3 different asset classes, and those are listed here on slide 8. The total fund did outperform its benchmarks for the 1-year period and since its inception, but it did underperform its benchmarks for the 3, 5, and 10-year periods. And as you'll see on the next slide, that underperformance was largely the result of fixed income and public equity assets missing most of their benchmarks. This slide shows you the performance for each asset class. Alternative assets met their benchmarks for all periods, but fixed income and public equity, as I said, underperformed the benchmarks for most of their time periods. Now, a written report includes much more information about the reasons for that underperformance. Here, I would briefly point out that Virginia 529 has taken several steps intended to improve the overall fund performance. And those steps include changing some of the approaches they use to manage the fixed income and public equity investments, as well as delegating additional responsibilities to staff. We will certainly continue to monitor those changes as they take effect to see whether there is improvement in the fixed income and public equity asset classes. Like the VRS Trust Fund, performance compared to benchmarks is critically important to the defined benefit fund. Investment returns are a key source of income for the fund, and that's in part because the other primary source of income, which is payments from account holders, are essentially fixed at the purchase price and can't be increased. But you will see on the next slide that the defined benefit fund is extremely well funded. As I alluded to, the defined benefit fund is extremely well funded. The funded status has grown steadily over the last decade, and that's shown here on the slide 12. The fund reached an all-time high of 194% in 2021. As of June 30th of last year, there was an actuarial surplus of $1.6 billion, which equates to a 99% probability that the fund has sufficient assets to meet its long-term obligations. Now, a key assumption for the defined benefit fund is the assumed long-term rate of return. And this slide just points out to you that the VRS or Virginia 529 board did reduce that return assumption from 5.75 to 5.5%. That was based on expected declines in both the public and private equity markets. Switching to the Invest 529 and College America programs, in both there's been substantial growth in the number of accounts and assets over the last decade, and the slide here shows you examples of some of that growth. This slide just summarizes the investment in returns for those two programs. So you can see that both programs underperformed a majority of their benchmarks for all or nearly all time periods. For Invest 529 options, the underperformance largely resulted from individual managers and their exposure to emerging markets. Now, the impact of the underperformance with Invest 529 is particularly concerning because these are accounts that are all held by Virginia residents, and because these are defined contribution plans, missing those benchmarks essentially translates into less money in people's college savings accounts. And next, I'll talk very briefly about Virginia 529's disability savings programs. The Able Now and Able America programs allow tax-advantaged savings for individuals with disabilities. Both are still relatively new programs and with relatively small numbers of accounts and assets, and those are just shown here on slide 17. Next, I'll talk about Virginia 529's implementation of a state-sponsored private retirement program. Legislation did pass the General Assembly in 2021, requiring Virginia 529 to implement a state-sponsored private retirement program for private sector employees. Employees with 25 or more employees are required to participate, assuming that they don't have or don't already offer a qualified retirement plan. Employees have to work at least 30 hours a week to be able to participate in the program. The program is scheduled to open in July 1st of 2023, and a key step toward that opening takes place later this year when Virginia 529 will conduct financial modeling, essentially to estimate the numbers of participants and assets and then the fees that would be needed to be assessed on participants. Those fees will be needed ultimately to repay the $2 million annual loan that Virginia 529 is receiving from the Department of Treasury to implement the program. And finally, I'll finish very quickly with some brief points about Virginia 529's initiative to support higher education access and affordability. Last year, the board and the Department of Planning and Budget approved more than $13 million in additional spending on access and affordability. And Virginia 529 is authorized to spend that money over the FY21 to 23 period. That is a substantial increase over previous annual funding levels. Now, the new funding is being used to support additional coaching and advising services for community college and high school students, as well as scholarships for certain at-risk high school students. And there is a table in our written report that provides more information about each of those programs. It's also worth noting that Virginia 529 did seek an additional appropriation of $16 million for the FY23-24 biennium. That money was ultimately left out of this year's Appropriation Act. In its place, there is language that directs JLARC to review the effectiveness of Virginia 529's Access and Affordability Initiative. And Madam Chair, that was a slightly abbreviated version of the presentation, but I'm still up here and certainly happy to answer any questions there may be.
Good, thank you. Are there questions?
Madam Chairman.
Yes, Senator Norman.
I was taken by the number of red X's that were up there in some of your graphics, and I guess there are a number of questions that could be asked, but I'm not an investment smart enough to figure them out. But what did strike me odd is on the fixed income situation, and why over a 10-year period, every segment that you had on the fixed incomes underperformed. You know, what adjustments were made over that 10-year period, and why was there not any improvement over 1, 3, 5, 10 years on fixed income?
Well, I can speak a little bit to this, and then I probably would defer to Virginia 529 staff to add a little bit of additional context. But in terms of fixed income, I know that based on information they provided to us, they traditionally have taken a defensive approach to fixed income to essentially guard against inflation and rising interest rates, and that had led to substantial underperformance in the non-core fixed income. One step that was taken, staff did eliminate one of the portfolios in the non-core fixed income sleeve, and they do believe that this will help improve performance going forward. I think I would defer to Virginia 529 staff to talk in more detail about that.
Madam Chairman, I look forward with anticipation to a better explanation. And I understand trying to create a hedge against inflation and interest rates. But if you haven't noticed, we're in the vortex of one right now. And that does not give me a lot of encouragement on the short-term performance on fixed incomes based upon the history of it, based on what we're dealing with today.
Senator Sproul.
I was wondering, is there anyone here that can answer that question? You know, we pass it on to somebody else, and I'm curious about that 10-year gap. Is there anyone else here that could answer that question?
I believe that Mary Morris will attempt to answer that question. Are there other questions? Okay. Okay.
Thank you, Madam Chair.
Thank you.
Thank you, Madam Chair. Or thank you, Jamie, sorry. And finally, Madam Chair, and also Senators Norman and Senator Sproul, last but not least, Virginia 529 will be presenting you with their annual status report. First, you will hear from Mary Morris, who's the CEO, and then you will hear from Michael Swink, who is their newly appointed investment director and should be able to answer some of your questions in much more detail.
Thank you. Good morning.
Good morning. Make sure I got this. Good morning, Madam Chair and members of the Commission. It is always a pleasure to meet with you and provide information. I'm probably also not the best one. I'm going to leave that to our new investment director, Mike Swink, except to note that it hasn't been for 10 years necessarily. Those are rolling periods. So when you have negative benchmark returns versus the benchmark, it sort of layers in. It was largely due to a convertible strategy that just didn't match up. It met its internal benchmark. The overall benchmarks are a little bit different, and so it was a benchmarking. So on an absolute basis, returns have been quite strong across all the programs against a couple of the benchmarks, which did not take into account the defensive bent of our program. Some of the remarks that Mr. Schmitz made about just the performance in public markets, whether they are fixed income or equities, sort of pertain. But I'm going to go through some of the other programmatic things, and then Mr. Swink will talk to you more about investments and investment returns. And before that, I'll just cover some of the basics. Peter Thompson, who is the program director for our retirement plan being developed, will also follow me with an update on progress there. And then Mike Swink, he's been with Virginia 529 for many years. Our investment director left at the end of calendar year 2021. We went through a national search as well, spent an amount of time. Mr. Swink was our interim director and is now our investment director, and he will review the returns for both the defined benefit program and Invest 529. I'll begin with our core mission in place from inception in 1994 to help make post-secondary education more affordable and accessible to all Virginians. The education savings mandate has been broadened in recent years to include helping Virginians discover and fund pathways to better quality of life through financial education and savings for individuals with disabilities and workplace retirement program. We're closing in on 30 years of operations, and our newer mandates build on our experience and expertise in education savings and financial education. Each financial category ultimately is about empowering people with knowledge and education and providing affordable and accessible ways to reach long-term financial goals. Access and affordability we view in two different ways at Virginia 529. One, through offering a variety of high-quality and affordable education savings programs, Defined Benefit 529, Invest 529, and College America, available to everyone with low opening balances, professionally managed investment offerings, and low institutional asset management fees. And second, by providing programs to assist Virginians who are not currently on the path to educational achievement for many reasons, related to lack of awareness, household income, geography, ethnicity, and race, and differing abilities. Closing the gap is a theme of our current 5-year strategic plan and relates to our goal of closing financial and educational gaps across Virginia to ensure everyone has access to education, tools, programs, and mentoring to meet their financial planning needs. All of our programs have continued to grow throughout the pandemic and recent market volatility, just as they did during the Great Recession of a dozen years ago. In raw numbers, account growth has continued. Invest 529 continues to see double-digit year-over-year account growth. Recent market volatility has had an impact on assets, but Virginia 529 continues to be the largest 529 program in the country and to enjoy the largest account growth margins in the industry as well. The same is true of our ABLE programs, even though the AUM scale is much lower. We work closely with ABLE programs across the country to affect federal legislative changes to make these programs more attractive to more participants. Our commitment to access and affordability has grown from the beginnings of the SOAR Virginia program in 2010 with 103 students in 7 schools to a program that now annually serves more than 3,000 students in 129 schools across Virginia. In recent years, as mentioned by Jamie, the Virginia 529 Board has increased its support of access and affordability initiatives, working with state partners like the State Council of Higher Education in Virginia and the community college system to support and expand existing programs related to college attainment and completion, workforce development, scholarships, and advising services. You can see on this slide the variety and scope of all Virginia 529 programs. Today, unless you have other questions, however, I will focus on the Defined Benefit 529 program, which, as you see, includes the Legacy Prepaid 529 program, closed to new entrants in May 2019, and the successor Defined Benefit program, the Tuition Track Portfolio, offered as a portfolio within the Invest 529 program, hence the dotted line that you see. As you heard earlier, the DB 529 program is the subject of JLARC staff studies on its funded status and the extent to which any actuarial surplus may be used to support higher education access and affordability in Virginia. This is a topic which the Virginia 529 Board reviews annually, and since at least 2018 is focused more on access and affordability initiatives. The Virginia 529 Board and JLARC staff are moving on parallel tracks and working together to explore these opportunities. With reports coming later this year, today seemed like a good opportunity to provide some background on the program. In 2018, as you may recall, after several years of study, the Virginia 529 Board proposed legislation to change the benefit structure of the Legacy Prepaid 529 program. The legislation was continued to 2019 to allow time for JLARC staff to study the work of Virginia 529. That staff report in late 2018 supported the Virginia 529 proposal for a new successor tuition benefit program with goals of being more flexible, more certain, more simple, and more affordable. With that endorsement, the legislation approving the change received almost unanimous bipartisan support, and after time for development in February 2021, the new tuition track portfolio opened. It has proven to be a popular option for our customers. In FY22, TTP was the 6th most heavily used of our 22 Invest 529 portfolios. I know this is a little bit difficult to read, but we provide many materials on our website, and this is a part of the JLARC report and the review, to educate current and potential participants about the features of the tuition track portfolio. These include a 2-minute video overview, charts explaining the costs, structure, and benefits of the TTP, my shorthand for the tuition track portfolio, and calculators to assist individuals in determining what may work for them and their personal goals. We have, as always, more work to be done there, but have been pleased with the uptake to date. For many years, will we be continuing to serve our prepaid 529 account owners with just under 50,000 accounts still in existence, as well as serving the growing cohort of new TTP customers who have purchased more than 500,000 units in over 5,000 accounts in just under 18 months of operation. And as noted before, assets in the DB 529 program exceed $3 billion. This slide just provides some numbers to attach to the concept between the tuition track portfolio. Units are priced and ultimately valued based on average tuition at Virginia's public universities. 100 units equals 1 year of average tuition. So 1 unit is priced at 1% of average tuition. For example, in the just concluded academic year, average tuition was $13,884 at our 15 public universities. So a TTP unit cost $138.84. Units may be purchased in fractions, starting with as little as a $25 contribution, may be purchased in a lump sum with recurring contributions or whenever one chooses to participate, up to a total of 1,000 units per student. When used in the future, the units are valued at then current average tuition and may be used for any qualified higher education expense at any eligible institution. And this is where the program differs most dramatically from prepaid 529. The value is always average tuition. It can be used at in-state and out-of-state public and private schools, not just for tuition and fees, but for any qualified higher education expenses. And it makes it easier for parents to decide what's the best fit for their student and not be based on what's the highest value of the program. Here you can see how average tuition has increased over time at Virginia's public universities, and it has moderated in recent years. As we discussed before, there also is a growing disparity between the most and least expensive Virginia public universities. However, as you might expect, most Virginia schools hover around the average, with 7 schools during the last academic year falling above average tuition and 8 below. However, only 3 schools were substantially above the average tuition cost, and only a few were significantly below that feature. With the tuition track portfolio, if you choose a school that falls below that average cost, and you have, let's say, 100 units for 1 year, you will receive more than tuition and fees, so you can cover more of your qualified higher education expenses. If you go to a more expensive school, you may purchase additional units, or you would have to make up the difference. But all of this takes us back to those themes of simplicity, certainty, flexibility, and affordability. So moving on a little bit more specifically to the Defined Benefit 529 program, a key to understanding any defined benefit program is the concept of an actuarial valuation. You've already heard a lot about that today with the VRS. I know you're familiar with that funded status. With respect to the DB 529 program, our funded status represents the estimate of calculated annually by our actuary to determine the likely or potential ability to meet future liabilities, those benefits promised to our participants. This chart provides examples of what various percentages mean to an actuary and shows how quickly the numbers can change, for the better, as in recent years, or worse, during the dot-com recession and the Great Recession. At the end of fiscal 21, the funded status in the program dropped a whopping 36% in a single year. It dropped by a similar percentage, as you can see, in 2009, when it went to as low as 85% at the end of that fiscal year. The lowest funded status this program has had is 80% during the dot-com recession. The 50 is simply shown as an example of a program that would have some very significant challenges. As you can see, a funded status of 100% merely means there's a 50-50 chance of meeting all future obligations. And again, as you can see, once you reach about 150% and above, a program has a high likelihood of meeting future obligations. Assuming all assumptions and variables remain constant and unchanged, that really doesn't ever happen, but it is a good guide for the health of a program. Again, just a little bit here today on the Access and Affordability Initiative. You can see the relationship between the non-general fund revenues generated by Virginia 529, operating expenditures, and allocations either to the DB 529 program, the historic allocation, or to Access and Affordability Initiatives, expanded by the Virginia 529 Board in fiscal 20 and 21. The DB 529 program does not assess administrative fees, but the other defined contribution programs do assess small administrative fees, reduced 4 times in the last 6 years, most recently January of this year. The effective administrative rate for both Invest 529 and College America currently is around 5 basis points, or $5 a year on a $10,000 account. It's less than 50 cents a month in fees. Any revenues remaining in the program at the end of the fiscal year by statute do not revert to the general fund, but remain in the special non-reverting fund of Virginia 529. As the funded status of the DB 529 program grew, the Virginia 529 Board allocated additional revenues to access and affordability programs in consultation with many state partners, and has kept JLARC staff and Money Committee staffs informed along the way. These programs and allocations are also under review by JLARC staff, as Jamie noted, and will be addressed later this year. But for some information on what Virginia 529 has been doing in that arena, we wanted to let you know, here's where we are. We're in the implementation stage of this Access and Affordability Initiative. We've executed a number of partnership MOUs, developed internal policies and procedures for disbursements, reporting, and partner evaluation, and are working with our partners to assess funding sufficiency and utilization. We conduct partner check-ins and engage as appropriate. We'll receive reports and metrics and assess effectiveness of each of these programs. It'll be distributed to the 7 partners that you see here over a 3-year period. The MOUs in place will cover that. This is similar to what we've done with the SOAR Virginia program. We don't spend it in 1 year. We understand that availability, spending authority may vary, and so we try to take a cautious approach on this. But the programs look like this. We spent countless hours working with state partners, including the Department of Education, Workforce Development, VCCS, SHEV, Access Partners, and others to develop themes for participation in specific partners. And you can see here who we've worked with. I know in the interest of time, I'm not going to go into those unless you have any specific questions, but this gives an idea of the types of programs that we've been trying to supplement and to work with using existing programs and the resources that Virginia 529 can make available to increase access and affordability for all Virginians. And finally, on this slide, I want to just cover a little bit on highlights. Again, I'm not going to go into any detail on these, but I'm happy to answer any specific questions that you have. I've talked about our sustained growth, about fee reductions. They have been substantial. We are reducing fees, not just in the administrative fees, but our asset management fees with some of the changes that Mr. Swink will talk about in our investment offerings. We continue to put a lot of effort, time, and resources into fraud prevention and cybersecurity. We work to enhance the customer journey along the way. We've made significant enhancements there, particularly with our contact center in the last year, multiple new system implementations, and a continued focus on diversity, equity, and inclusion, which goes along quite well with access and affordability initiatives. So unless there are any other questions for me, I'll turn this over to Peter Thompson.
Madam Chair.
Yes. Sure.
Go ahead.
Senator Norman.
Senator Norman.
And Senator Sproul.
Yes, Madam Chair, not for her. Madam Chair, I'm hoping that when we have a question, that Senator Norman asked a question sometime back, and we just went on to the next speaker, it just bothered me when I saw them read X's and so forth, and someone asked a question, you went to the next speaker, my mind was trying to pay attention to what you were saying. But at the same time, I'm saying, why we can't get an answer for the question that was asked? So we go to the next speaker, someone else can talk about it. When? It says to me,
Well, we
Madam
can
Chair,
flip the script. Why don't I have Mr.
No,
Swink come
be
up
cool,
right now?
Be cool, ma'am.
And
be
Mr.
cool,
Thompson can
be
finish
cool.
up. We can flip.
No, my question, I don't want him
Okay.
to talk about it. His portion, I understand that, but when a question is answered, it would not have hurt, Madam Chair. People get up and just answer the question, not talk about his whole presentation, talk about that. But when a question needs to be answered, as a part of this, my mind is working on that particular question had not been answered, and we move on to another subject. And I'm saying, why can't someone get up and answer that question, not talking about your whole project, just that one question? And that's bothering me when I don't get that.
And I'm sorry, he was ready to hop up when Ms. Sartay was up in front of you, and I suggested just waiting until we got to his presentation. So that's on me and not trying to jump in front of somebody else, but to follow the commission's protocols for speakers. So my apologies for that. Again, I tried to address it a little bit, but he has the detail for it. So we can flip forward very easily, and why don't I suggest doing that?
Before
and
he
have
comes
Mr.
up,
Senator
Okay.
Norman has a question for you.
Okay, that's fine.
I was looking with some interest on page 24 of the draft on Table 8, and that's Virginia 529 is committed to providing more than $13 million in additional funding for higher education access and affordability.
Yes, sir.
On that. What I guess a couple of things. What sort of caused me to pause is just on that little graph, it showed that there were 60 people hired to implement that program, 60, according to your graph. And the amount of money attributed to it, again, based on what's in the graph, was 6.25 million. So I'm kind of interested in that, but more importantly, I'm interested in, are there any metrics that you have that are demonstrating the penetration and effectiveness of this program?
Well, so a couple of things. We actually have not hired any personnel for the access and affordability initiatives. That has been done so far with existing personnel. Most of the personnel increases in our staff over the last 5 years have been in our contact center and in our IT group on fraud and cybersecurity.
Let me interrupt you, if I may. You know, I'm not a very smart guy, you know, but I'm looking down here, fast forward, additional 15 career coaches. I'm looking down here further. Great aspirations, additional 16 advisors. That doesn't suggest to me that there's being internal individuals that are used, and that's why I asked the question.
Yes, sir. I'm sorry. They are not employees. The resources that Virginia 529 is able to provide will support that additional personnel. So, for example, in the community college systems, to support Fast Forward and the G3 program, the Rural Horseshoe Initiative that the community colleges have been working on for a number of years, as well as the Great Expectations program. So a number of different programs. They do not have any advisors, no adult who is working with students in those programs in all of their schools. So the resources that are being provided by Virginia 529 will allow them to hire career coaches, advisors, they call them different things, in each of the 23 community colleges in Virginia. So most of the Rural Horseshoe right now doesn't have anyone filling that role. And the resources that we're able to provide, again, after communications with all the different programs and talking to the community college system as to what would be most helpful, that was what they recommended, because we are under the national average for providing that type of mentorship and advising to our students. Now, I've just come across some, Tennessee is a few years ahead of Virginia, I guess, in providing some free community college offerings, but what they found through a number of studies is that what really impacts attainment and completion of those programs is the mentoring and advising that can come from some of the programs that we're talking about. We've always found that with our SOAR Virginia program. So again, some of the resources there, you'll see that are going to the Virginia VCAC, which is out of UVA, does the same type of thing. We are allowing them to place more access providers, more mentoring, more advisors. They use a near peer model in more of the Title I schools and the more challenged schools across the Commonwealth. So that's always been our focus, starting with the SOAR Virginia program, looking to schools that are under-resourced from any variety of means, that have a higher proportion of students who require or fit the criteria for the National School Lunch Program, and provide resources in those schools to mentor them, to make sure they're on track for graduation, to make sure they're prepared to enter some kind of post-secondary education. They help them with their FAFSA applications, which has been tremendously down during the pandemic, and they're trying to get those numbers back up, and also help them tap into other sources of financial aid. The SOAR program also has a scholarship component, as we've talked about over the years, but these other programs are simply to provide some of those advising services. So, is that helpful? And again, the programs we would hope to continue. We will hope to be able to continue funding these programs. And I thought your question might have gone to the resources available. Again, we charge a very low administrative fee. We have reduced it. We continue to reduce it. Again, we did it just 6 months ago. However, we also continue to have double-digit account growth and asset growth. And so that increases our revenues. So we have come in over budget on revenues in the last many years, and we generally come in under budget on our expenditures, and that provides resources to support these access and affordability programs, which again have been part of our statutory mandate since 1994.
Madam Chairman,
Yes,
I
Senator
appreciate and perhaps understand your explanation. Do you have any metrics as to what the impact of this program is? And I don't mean anecdotal. I mean, do you have any metrics that are showing the penetration of these programs?
So we do for our SOAR Virginia program, and we've provided those in past years. I think we have some of our information in the appendix that we have. We don't for these other programs because we are just starting the funding. However, they are mostly existing programs. So for example, the resources that we're able to provide to SHEV and the Gear Up program, Virginia's been a participant in Gear Up, which is a federal grant program for about 40 years, I believe. And so the monies that we're able to provide allow them to leverage the scholarship component of that, and again, put more adult advisors into the high schools where there's the greatest need. So those programs have been assessed. We have those assessments. We have the assessments that VCAC has done. We have individual assessments. We're just starting that process, and that'll be a part of the JLARC review as well, and we've been talking with them about that, what the metrics are, gathering those, and ultimately assessing the effectiveness of the programs. How many students are being helped, and some of that information is in there. We expect to increase by a substantial number the amount of students who are receiving support. It takes more than 6 months or a year even to really assess the effectiveness of these kinds of programs. We're talking about generational change in some instances, but we absolutely will have information on the penetration, number of schools served, number of students served, numbers of contacts between those mentors and advisors, numbers of scholarship dollars assessed. We're also following our students into college to try to ascertain not only do they make it to some post-secondary education, but do they make it through? Completion being one of the largest problems in higher education in this country. Students get there, they often take on debt, they don't finish the degree, they don't finish the certificate, and they end up owing money that they don't have any way of paying back. So our goal has always been to get students not just to college, but through college, and so that's what we'll be assessing. But we don't have a lot of that information yet because we're just starting. We have not distributed most of the funds for these programs.
One more brief question.
Senator Gomer.
I appreciate that this may be a pioneering program. When do you expect when can we reasonably expect that there will be some metrics that you will be able to gather?
Well, by this time next year, we'll at least have one full cycle around, and we will have
I'll look forward to
implemented
that.
the programs.
Thank you.
And over the next several years, absolutely. But these, again, they are all programs that have been in existence and do have external other supporters. So I feel confident we'll be able that everyone will be pleased with the results.
If I might add, the Southern Regional Education Board, which Senator Locke is extremely active with, and I'm sporadically active with, has demonstrated over and over and over again the value of these mentoring programs. They make, yes. There's no question that they work. I think, I guess the question is this one located in the right place, being managed in the way that's most educationally valid? And that I have no way of knowing. But in terms of the mentoring programs themselves, they're absolutely essential.
And again, we don't presume to have that information. We're working with the experts in that to get the right placement and utilization of the resources that we provide. If I may, I'm going to switch the order, and I think you all can find it. And I can introduce now Mike Swink, who is our new permanent investment director for Virginia 529. He's been with us for a number of years, has been in an acting capacity for a number of months, and he will address the specific questions raised on the investments part of the portfolio. And then when he finishes, he'll turn it over to Peter Thompson to give you a little bit of information about where we are in opening up the Retire Path Virginia program. Mike?
Thank you. Welcome.
Thank you, Madam Chair, members of the commission. First, I'll start out, Senator Norman and Senator Sproul, by addressing your question on the fixed income relative underperformance. It's entirely attributable to a convertible bonds mandate. Convertible bonds are a hybrid security which include characteristics of fixed income and equity. So across the style spectrum, you can select convertible bonds that act like an equity or act like a bond. We had selected a very defensive posture. Historically, as the investment program was more focused on absolute returns at that point in time versus relative returns. So effectively, we ended up with a benchmarking situation where you're comparing a bond to an equity. If you think back to the market environment historically, take out calendar year 2022, where we've seen some dislocation, very strong results. So equity markets have risen sharply. A defensive convertible bonds mandate is not going to hold up to that historically. I've got some numbers on it as well. On the trailing 10-year number, there's 47 basis points of underperformance within fixed income. 62 basis points of that would be attributable to this convertibles mandate. So if it were not for this mandate, we actually would be positive in that time frame. I'll talk through some of the changes that we're making, but we've eliminated convertibles from the asset allocation. The termination letter's already gone out to the manager, and that transition is set to occur later this month, actually. So I'll start out my remarks with some slides on governance. There's three pillars to our investment program: the Investment Advisory Committee, staff, and our consultant. The Investment Advisory Committee is the overarching governance body. They set policy, provide oversight of staff execution. Staff, me and my team, were responsible for portfolio management, manager selection, manager due diligence, and operations. And then finally, the consultant, we leverage for special projects, investment manager research, and generally the sounding board for ideas. We've recently expanded the Investment Advisory Committee to include even more specialized investment expertise, added 3 members last year. The committee has multiple CFA charter holders, economists, private market specialists, asset allocation specialists, operations specialists, a large breadth of expertise on the committee. Similarly, staff has expanded recently via a new analyst. We'll also be expanding further now that the investment director role has been filled in a permanent capacity. And strong credentials on the staff side as well, with tenured experience and CFA charter holders. Finally, Mercer, our consultant. We have 2 long-tenured field consultants with dedicated support resources, as well as dedicated specialty consultants for ongoing projects like asset liability studies or Invest 529 glide path reviews. Continuing on the governance theme that's important, it was in the report that Mr. Bitts mentioned, 2021, the decision was made for manager selection to be delegated to staff, where previously the Investment Advisory Committee interviewed and selected the investment managers. The IEC made this change as they agreed that staff was best positioned to make these decisions, given that we're in the day-to-day versus a governance committee that meets a limited number of times per year. This exhibit just shows the process at a high level, where the committee sets asset allocation and decisions below that level are left to staff. This slide shows some of the work we've been conducting this past year and actually illustrates well the roles of IEC and staff. So new asset allocation was approved in August 2021. This asset allocation was very similar in investment exposure to the legacy asset allocation, but achieved risk and return objectives with less complexity. So those were IEC directives, were to simplify where it made sense in implementation, be conscious of fees, and remain benchmark aware. To give an update on what we've implemented to date, we've restructured the equity book based on the new higher level policy index, which is a largely recognized global benchmark. With that, we took managers in the equity book from 7 to 5, a 30% reduction. And we expanded the use of passive management to encompass all of domestic equity, where previously only domestic large cap was passively managed. That change cut the equity book's fees in half from 51 basis points to 24 basis points. On the alternative side, we removed hedge funds from the allocation. We were able to achieve similar risk and return objectives at the portfolio level without the hedge funds. Hedge funds are complex, hedge funds are expensive, so it all aligned with the initiatives that we were trying to achieve. Similarly, on private equity, previously we had utilized a fund-of-funds approach, which is more expensive. In March, we were able to engage a private market specialist to run a custom private equity separately managed account for us. We committed $400 million to be deployed over 5 years, and this change reduced the fees associated with fund-of-fund structures. We also were able to achieve some operational efficiencies as well, as we had them take over some reporting work that had been conducted internally. To round out alternatives, real estate allocation increased as well. We've been working to get that up to target and made 4 commitments to date. On the fixed income side, I already went through the convertible bonds, which are being removed from the portfolio. And then also we've engaged 2 core bond managers to bring the core book more in line with benchmark. Moving along to the Invest 529 program, a comprehensive review of the target enrollment funds glide path was conducted in May 2021. This is a good example of a project where we partner with specialists from Mercer, and results showed that without taking excessive risk, more growth assets could be added to the glide path to allow savers to hopefully cover a higher percentage of the ultimate tuition burden. So on the chart, the green line was the legacy asset allocation to growth assets across the glide path. The blue line was the initial alternative glide path that was evaluated, and the dotted line was a hybrid of those two that we ultimately selected. You'll note that after age 14, the hybrid and legacy lines converge. This was by design, as we wanted to be very vigilant about how much risk a participant was taking in later stages of the glide path. Unlike retirement assets that draw down over an extended period of time, 529 assets draw down quickly over a 4-year period once benefits begin being used. We made a similar change in this program as well, where all of domestic equity is moved to passive management. And the result of all these changes resulted in a 22% on average reduction in fees assessed to participants. Mary mentioned earlier the program administrative fee. So when you layer that in, the all-in fees to participants were reduced about 28%. These changes were implemented in January 2022. I'll now shift to go through the portfolio and some results. This pie chart is important because it shows the asset allocation. And asset allocation in investments drive north of 90% of returns, which is why I primarily wanted to share this. I won't get into great detail on this exhibit. This exhibit, similarly to the exhibit you would have seen earlier from the VRS, shows defined benefit 529 annual performance compared to the actuarial assumption for that year. Would point out that largely we have come in above assumptions, and that there's also several outliers in there that can really drive short-term results. Notably the great financial crisis in 2009, that was associated with a 85% funded status. And then on the flip side, in 2021, the outsized returns, which resulted in a 40 percentage point increase in funded status. Lastly, on this exhibit is the fiscal year-to-date return through May, which is negative 1.79%. We don't have June numbers yet, but I would expect them to be slightly lower given the markets. The right side of this exhibit shows the high-level results. This aligns with the report that Mr. Bitts showed earlier. The 1-year trailing return has beaten benchmark primarily due to alternatives holding up. The 3-year has outperformed, assisted by some changes made within the equity book to reduce.
Mr. Swink, you have the unfortunate position of being the very last presenter, and we're starting to lose a number of our members. So I'm wondering if you can shorten it for us.
Yes.
Thank you.
The next slide really is a detailed performance. I won't go through that unless there's any questions. The following slide is performance for the Invest 529 program. Main point on that slide would just be the calendar year to date return, given the macro backdrop, depending where a participant is on the glide path, down anywhere from about 0 to negative 10%. And then finally, the tuition inflation or the long-term investment return assumptions, which have come down from 8 to 5.5 since inception of the program to now. So happy to entertain any questions from the commission.
Boy, when I asked you to shorten, you did. Thank you. Are there any questions? I don't see any. Thank you very much.
Thank you.
Good afternoon, Madam Chair and members of the Commission. I will be very brief. My name is Peter Thompson, and I am the Retirement Program Director for RetirePath, Virginia's state-facilitated private retirement program. And see if we can find the slides. Start there. Thank you. And just very quickly, I'll begin with the program name and branding, RetirePath Virginia, which some of you have seen. I do want to thank Virginia 529 staff and particularly our marketing team for their work in establishing a distinctive and a memorable identity for the new program to make saving for retirement feel simple, achievable, and necessary. Of course, the program name and brand will play prominently in our marketing, communication, and outreach efforts with stakeholders, employers, and employees as we move towards program launch in the summer of 2023. I'm also pleased to share with members of the Commission that our program website, retirepathva.com, is now live. I encourage members of the Commission to explore the website and subscribe for updates. Very quickly, as it relates to the program overall and implementation since legislation was enacted, several updates and recent developments to report on, which I'll share. With respect to the analysis and strategy, and going back in time, just a little bit for a refresher, pursuant to Chapter 506 of the 2020 Acts of the Assembly, Virginia 529 submitted an in-depth study to the General Assembly in December 2020 that moved the state-facilitated private retirement concept forward in Virginia. The 2020 report not only helped to inform how Virginia should implement the program based on the experience of other states with auto IRA programs, but also inform the program design elements that were approved by the board in December 2021, including the account type, the default contribution rate, and the annual automatic escalation rate. These design elements were necessary for the development of the RFP for Program Administration Services that was issued this past February. I'm pleased to say that in May, the selection of the program administrator, Vestwell Holdings, in partnership with Bank of New York Mellon, was completed. Coincidentally, the analysis and design of the appropriate investment fund options and selection of an investment manager were also completed in April. Currently, in the implementation phase, Virginia 529 is working with other state agencies to collect information relevant to administer the program. As noted in the oversight report, Virginia 529 is also working to develop asset and revenue modeling that will help to inform the appropriate state fee structure and projections for the program to become self-sustaining. And as we continue stakeholder engagement with those organizations that may have an interest in supporting efforts to raise awareness, we are also developing an outreach and education campaign that is planned for later this year, ahead of a pilot launch in early 2023. We've achieved several key deliverables and milestones and are on track to open in the summer of 2023. The next slide just very quickly provides an illustrative timeline that highlights key milestones. You'll see here where the timeline estimates a pilot launch in April of 2023, but given the progress that we've made, very likely that we have some flexibility around that date and we'll be able to launch sooner than that time frame. And then very quickly and lastly, we wanted to provide a little background on the Retirement Program Advisory Committee, or RETIRE-PAC, and highlight both the experience and the expertise members bring to the committee. Pursuant to Virginia Code Section 2.2-2746, the purpose of the RETIRE-PAC is to assist the board and the CEO in directing, managing, and administering the Commonwealth of Virginia state-facilitated IRA savings program. The committee consists of 9 members who are appointed annually by the board and may include both board and non-board members. Members of the committee who are not board members shall demonstrate experience in one or more areas relevant to defined contribution and/or IRA retirement plan design, management, administration, or investment management. And Madam Chair, that concludes my remarks. Are there any questions? Thank you.
Hi, Madam Chair. I just wanted to respond to a couple of the very good questions that were asked earlier before Hal closes out the meeting, because I'm sure some of the other members have similar questions. On the investment performance, we really agree that that underperformance is not acceptable. What it means for the DB plan is this money that's left on the table for things like Invest and College America, where people actually have accounts. What underperformance means is people have less money in those accounts for college. So we share the concern, and it is something that we have been watching and will continue to watch and look at more closely if it continues. On the access and affordability programs that Senator Norman was asking about, that is something that we will be covering in our fall report to you. We will be looking kind of at broadly at the kind of the literature supporting kind of the effectiveness of those programs, and then the SOAR Virginia program, which is the one that Virginia 529 has had for the longest. We are actually doing a deep dive on that, and we'll have some pretty good information for you on effectiveness. So I just wanted to address those two things.
Madam Chair, that concludes our agenda. Thank you for staying with us so long, the 5 of you who are still up here. Our next meeting will be Monday, October the 17th. There will be no September meeting. On the agenda for October will be presentations on the prepaid 529 surplus funds, regulation of gaming, Virginia income tax progressivity, and our annual update on state spending. Thank you very much.
And I would just tell the members that since we're not meeting in September and this is going to be a jam-packed October meeting, it may go a little longer. You plan the one in October. I mean, than this one even, yes. If there's no further business, the committee will rise.